Hi folks, we are starting our technical analysis module from here, and firstly we'll talk about the candlesticks. Candlesticks are the most basic pillars of stock market of forex market. It is a visual representation of price movement. It is a kind of building block that creates whole market structure. Whenever you look at the chart of any currency pair, you will see two types of candle. A green candle which indicates bullish momentum, meaning the price is going up, and a red candle which indicates bearish momentum, meaning the price is going down. Now let's simply understand the anatomy of a candlestick. This is body of a bullish candlestick. These are called wicks. This is high, low and open, close. Now remember, high, low and open close are different for bullish and bearish candles. A bullish candle opens like this. Buyers took full in charge and pull the price upwards, and it closes above the previous recent price, and it's reverse vice versa in bearish candle. A bearish candle opens like this when sellers took full in charge and pull the price downwards, and it closes below the previous recent price, and that's how bullish and bearish candlesticks are formed. Now if you ever go to Google and search for candlesticks pattern, you will find countless types. Literally there is an entire encyclopedia of them. But do we really need to know every single one? Well, no. There are mainly three types of candlestick patterns. We'll use these patterns mainly while trading. Number one is engulfing pattern, number two is hammer pattern, and number three is doji pattern. Now let's talk about this in details. First is engulfing pattern, bullish engulfing pattern and bearish engulfing pattern. If you ever see this kind of a pattern where a giant big candle with maximum body and minimum wicks forms after small candles, it is called a bullish engulfing candle. It means this is a giant candle which can engulf all these small candles, which indicates a very strong buy, meaning many buyers are active here and are in control after this candle formation. So do we need to buy whenever we see this kind of a pattern? Well, no, it's not that simple. We'll take a look later where we have to buy. Now, bearish engulfing pattern is the opposite of bullish engulfing pattern. If a big red candle forms that can engulf its previous candles, that is called a bearish engulfing candle. That indicates there is huge selling pressure from sellers. Let's take a look at these examples. A big decline came into the markets and a big bullish engulfing candle forms, and from there onwards the rally starts. And vice versa, market was in a bull run and a big bearish engulfing candle forms here, and suddenly market starts to drop. Don't worry, when we will talk about our premium strategies, you will know everything when to buy and when to not. Now our second candlestick pattern is hammer. But before that, I have to tell you that we have a Telegram page of Expert Emirates where you will get live guidance of the market. So join the Expert Emirates Telegram page as soon as possible. Now hammer candle literally looks like hammer. This type of a candle opens from here, make a low like this. Market buyers took whole in charge of this candle and make it close above the high. So this was a bullish kind of a candlestick where the buyers are heavily dominating. Now there is a bearish hammer as well, which is called a pin bar. In pin bar, this candle opens like this. Buyers try their best to move prices higher, but then sellers comes again and push the prices downwards and closes the candle above its low. Bullish hammer and bearish hammer is one of the most impactful candles. If we take a look at the examples of this, you will see in a downtrend, if a bullish hammer forms, it is a big sign of a reversal. It means it was in a downtrend, but now buyers are being active here and prices will be pushed further in the near future. And vice versa, in the bearish hammer, which is a pin bar, market was in an uptrend and suddenly a pin bar forms, which means there's a high probability market will reverse from here and will go down. Don't worry, you just need to know the basics of these patterns. I'll teach you how to use this, where to use this in our upcoming premium strategies modules. Now the last important candlestick is doji. Doji something look like this, like a cross. This candle open like this, the price moves upwards, it makes a fresh high, sellers come again and push it downwards, making a new low, but then again buyers came and pushed the prices upwards once again, and a tug of war kind of a situation is happening here. Buyers want to move market upwards and sellers want to move markets downwards, and that's why it closes in the center middle, and this is called a doji. Doji is one of the most impactful reversal candlestick pattern. For example, if there is a bearish trend and suddenly a doji forms, it means there is indecisiveness in the market and neither buyers are sure nor sellers. And this indecisiveness leads to a reversal change. I hope you have understood all these three most impactful and important candlestick patterns, and all you need to know is the basics how these candles are formed. In our upcoming module, we will see where we are going to use these patterns. Also, if you are a struggling trader, I'll suggest you to join the Expert Emirates community as soon as possible, where we manage our clients' funds and help you grow your account and make lots of money.